Last week, I came across an interesting article which speaking to how to use or leverage a reverse mortgage for the purpose of an early inheritance. And this is from a faith-based website called FaithFi, and they actually had a podcast interview with Harlan. So I just want to go over some of the comments he made, and it could maybe perhaps spur some conversations with potential reverse mortgage borrowers. The column begins by saying the best time to plant a tree is right now, but does that same logic apply to inheritances? And parents have some varying feelings when it comes to this. Now, it explores the question whether or not there are, in fact, benefits to giving adult children their inheritance early. And in that podcast, Harlan Nicola, by the way, who is Movement Mortgage's National Reverse Mortgage Director, sheds a little bit of light on the subject. And one of the things that he notes is one of the most meaningful ways that you could use a reverse mortgage is to give an early inheritance or legacy. In other words, giving the children and grandchildren some of those funds or utilizing them in such a way where you can witness its impact. And Nicola quotes Ron Blue, who famously said, "Do your giving while you're living, so you're knowing where it's going." That kind of rhymes, right? Obviously. So he notes that an inheritance could be an opportunity to help guide the next generation on not only how to be a good money manager, but their ability to be generous and to be philanthropic as well. So he says one of the reasons it makes sense is it allows them to teach their children on how to manage money and also to understand how to be a good steward. And of course, for those of you watching right now that are parents, you know, as a parent, you're doing that from a very young age with your own children. But, things change too when they're an adult. So he looks at the various ways that an early inheritance may perhaps help. So let's examine those. And the first is with a down payment on a home. And my goodness, in another story on this very podcast, we're talking about the challenge of housing affordability. And shucks, it's really difficult to get a home. So that could be a great way to see the blessing of an early inheritance for your children or grandchildren. And for the audience of FaithFi, of course, these are faith-based individuals. They would also appreciate the ability to maybe use a portion of those funds on a reverse mortgage to help fund private education for their grandchildren. For myself, my younger brother and I were sent to a private Christian school for 3 years. My dad did that on a single salary as a police officer. Don't know how he did it, but I tell you what, it's gotten even more expensive today. So private education is another way, and then to support a family mission trip or vacation. Last year, we had Harlan on this podcast, and he spoke to us about the idea of a reverse mortgage vacation, basically using a portion of the proceeds to help fund a trip with the entire family and building that which matters most, and which is experiences and memories over things. Now, what are some of the risks that should be weighed before doing that? Of course, the older homeowner who is considering a reverse mortgage will want to look to and make sure that their own needs are being met, both immediate and long-term. And part of that is considering unexpected healthcare costs, because as we age, stuff happens, parts wear out, we all know that. And then using the funds wisely, Harlan suggests that these early inheritances should be given with intentionality. In other words, there needs to be some sort of plan or a strategy to help the adult children or grandchildren with those funds. So this is just another way that a reverse mortgage can be used. I think it's a very creative way, and I just wanted to share it with you all. If you run into individuals who are maybe not needing a reverse mortgage, perhaps they've never considered the option of what I like to call a living inheritance. It used to be that non-permanent resident aliens were in fact eligible for FHA financing, and I want to give you that background because it's going to be very relevant to our story. On January 19th, 2021, and that was the day before President Joe Biden took office after President Trump's first term, the Federal Housing Administration announced a sudden change in their policy, and they extended eligibility for FHA loans to non-resident aliens and dreamers. Now, how many non-residents who have taken an FHA-insured reverse mortgage really remains to be seen. But during President Trump's first term, FHA had changed their policy. So Biden reversed it, and he said, no, dreamers don't qualify for these home loans or government-backed loans because of how the FHA was interpreting a 2003 passage from its single-family policy housing handbook. So this particular email from the department says that HUD has removed access for illegal aliens to FHA-insured slip of the tongue, FHA-insured mortgages, which, yes, does include reverse mortgages, by eliminating in its entirety the non-permanent residence category from both Title I and Title II programs. And that update's also going to be put into the handbook. And lately, and this is quite interesting too, the emails, the press releases that we receive from HUD are including links to news sites. Of course, they're conservative news sites. And I hadn't seen that in the past with the Biden administration, of course, not conservative, but more perhaps left-leaning sites such as MSNBC or CNBC or ABC. They didn't include links to them, so there's just a completely different approach on this, but they're citing a column in the National Review. So let's talk about the particulars and how this could impact potential reverse mortgage borrowers. So I'm going to boil down for you just real briefly why we're seeing this. It was during President Trump's first term that he said that dreamers did not qualify for federally backed mortgage loans because of how FHA was interpreting a 2003 passage from the single-family housing handbook, which read, non-U.S. citizens without lawful residence in the United States are not eligible for FHA-insured mortgages. And that seems pretty straightforward. Now, just to let you know, dreamers are those undocumented immigrants who came to the U.S. as children. So they probably arrived with a parent or a relative. And at that time, FHA's reasoning was that the agency did not anticipate a situation in which a borrower may not have entered the country illegally, but nevertheless was considered to be lawfully present. Then last week, the Department of Housing and Urban Development released Mortgagee Letter 2025-09, which really spells out this policy. So let's talk about one of the reasons that they're doing this. And they're saying that they want to eliminate uncertainty. I'm going to look at this particular quote because I think it really sheds some light on the rationale. And so let's look at that real quick. So here's one of the main rationales given in the Mortgagee Letter. It says, currently, non-permanent residents are subject to immigration laws that can affect their ability to remain legally in the country. And that uncertainty poses a challenge for the agency, for FHA, as the ability to fulfill long-term financial obligations depends on stable residency and employment, which makes perfect sense. So if someone does get deported, then that's going to potentially lead to a foreclosure. Now, HUD's revised rules will be going into effect on May 25th, and they will apply to DACA recipients, that is a deferred action for childhood arrivals, and even those who have pending asylum or refugee status hearings. So these changes will be incorporated into a future version of HUD's single-family housing policy handbook, which, by the way, enumerates the regulations for traditional and home equity conversion mortgages. In the final analysis, the real question is just how many individuals who were non-resident aliens utilized FHA loans, any kind, whether it's traditional or a home equity conversion mortgage. And likely that number is minuscule, and here's why. A 2024 brief from the Urban Institute estimated that between 5,000 and 6,000 home loans of all types, by the way, were made to those using an individual tax identification number, or ITIN, and that's what non-resident aliens typically use because, yes, they don't have a social security number, so that's a common practice. So they looked at application data and they found that between 5,000 and 6,000 home loans had an ITIN number instead of a social security number in 2023. So I think the impact of this on reverse mortgage lending will be minimal, if noticeable at all, but we do need to be aware of the recent changes in the Trump administration when it comes to housing finance for federally backed mortgage loans. So the question in this week's story is, how could total home sales influence reverse mortgage lending? We're going to dive into that. But first, let's just acknowledge the elephant in the room. Existing home sales have sunk to a new low, that thanks to record high prices and elevated mortgage rates. Wells Fargo's Housing Market Outlook research found that January's new and existing home sales were just barely above the tepid rate that we last saw during the Great Recession and housing crash of 2008 through 10. Now, for some perspective, there was only 4.7 million new and existing homes sold in the month of January, when we had 6 million sales just before the pandemic, the COVID-19 pandemic. So now we have some unique differences than 2008 and 10, and namely is that we do not have a recession that's pushing down home prices. In fact, it's demand that's been decimated due to the run-up in home prices, which quite frankly are just at ridiculous levels. And we had record low mortgage rates, which were fueled by the Federal Reserve's repeated interest rate cuts. So it was much of a self-fulfilling prophecy. So let's take a look to see what this column has to say. So here are some of the highlights. Housing activity entered 2025 with what they say modest momentum. That's being very kind. And it reflected slightly reduced mortgage rates in the second half of the year. And then material relief in terms of housing affordability does not appear to be on the horizon. And I concur with that assessment. Now, there has been some easing, says Wells Fargo, in the terms of financing costs and tight inventory. But they say they expect the supply and demand imbalance in the housing market to be around for a while and to actually exert modest upward pressure. In fact, Zillow has pretty much called for maybe a 0.6% increase in housing prices this year. They revised their forecast downward. So they're looking at a stagnant housing market, which of course would impact reverse mortgage lending. So there's a lot of uncertainty right now in the overall economic environment due to tariffs and tax and regulations. That's also going to have an impact as well. So let's look at the total home sales as seen in this chart. So we're looking at the years 2000 through 2025, early 2025. And do you remember the housing craze just before we had the crash that really began in the years preceding 2008, believe it or not? So we can see we had about 8.5 million units being sold, total sales, new and existing, in 2005. And if you bought a home then, I'm sorry, a lot of us did, and we could see that the home sales just plummeted in the following years, and prices began to follow suit after the home sales really fell. So there was very little demand, and then we saw as the market began to recover, it moved up nicely, and then of course we had that big drop right here due to the COVID-19 pandemic in the early spring of 2020. And then look, we bounced back up, but then the Fed had to slash interest rates, which of course changed the whole housing picture. So we know that January's home sales were just not impressive at all. And of course, that suggests we have sustained affordability issues with high mortgage rates, and wages are generally stagnant, especially when you account for inflation. So let's consider this. In January 2025, 22.8% of sellers nationally reduced their home prices. So we're seeing home price cuts. And that's because I think a lot of home sellers are finally waking up and smelling the coffee and realizing you can't sell your home at 2022 prices at 2025 interest rates. The world just doesn't work that way. Now, what is different between 2008 through 2010 actually versus right now? And it's one thing is that we don't have a recession. And so Selma Hepp, who is the chief economist at CoreLogic, told MarketWatch, generally, if a recession is accompanied by significant job losses, there could be a jump in for sale inventory, which would reduce home prices and drive up foreclosure activity. But economic recessions, by the way, have not always resulted in a drop in home prices, believe it or not. But when a recession does push down home values, high unemployment and reduced wages shrink a buyer's ability to afford to remain in the home or to buy a home. And banks become much more cautious. They tighten their lending standards, and that makes it more difficult for home buyers to qualify. That increases inventory and reduces demand. And homeowners who are already in their home and are struggling due to a job loss or even just inflation, which is baked in now, may be forced to sell or foreclose, especially with those skyrocketing homeowners insurance premiums. And that could cause a flood of inventory to enter the market and trigger a wave of price reductions, much like we had in 2008 and 2010. So we're not under the same economic regime, we might say, as we were in previous years, but Wells Fargo is pointing out that we have some similarities in the constriction of home buying. And so we'll keep an eye on this. Again, these are trends that we're going to be tracking very closely when it comes to the overall housing market, because it's easy to forget as reverse mortgage lenders that the traditional mortgage market has tremendous weight and bearing on reverse mortgage lending, especially when it comes to home values.